Hello, this is Coach Mike. We're going to do a bit of a walkthrough on a chart study for Apple, one of our focus group charts. And really, this is a training video on a very, very successful and effective approach to some short-term trading on the Apple chart. And this is one of our focus group charts. We look to have many different ways of trading each of these charts. Now, going through here, I'm going to be discussing Fibonacci Extensions, one of many trading tools that you can use. And if you have your Thinkorswim open, you can click on Drawings, go down to Fibonacci Extensions. And this is basically a 3-point tool used to calculate a target point based on a prior move. Now, going through this study, you're going to find a lot of accuracy, but as we start, just trust that, when I look at a targeting system for trading, I don't really care if my target is broken. Actually, I prefer that my target be broken more times than not, because if I'm trading according to that target and I entered the trade seeing that target as worthy of a trade entry, the target getting broken actually just makes the trade that much better. So there's a couple little things that you're going to find from my personal studies with the use of this system. Now, I want to alleviate any confusion quickly by saying that when you're using the 60-minute chart and the trading system with Fibonacci extensions that we're going to go over, you want to make sure that you have 2 weeks until the expiration of the options. Now, when you hear me say that, I'm not necessarily meaning 2 weeks from a Tuesday, because typically the options expire on a Saturday, or you might see them, they expire on a Friday, or you might see them on a Saturday, which is the monthlies that expire on Saturdays. What I mean is that Monday, if you were to enter a trade, any given Monday, you would have the choice of several different expirations, and we wouldn't want to take the ones for this trading system that expire in the same week that we're trading. We would want to go to the following week. Now, with that being said, Monday and Tuesday, I think you're still okay to go to just that next week. Wednesday, most times you're going to be okay just to go to the next week, but you'll see some different volatility, and if the trade doesn't go your way, it could hurt you. Come Thursday or Friday, you actually want to be out another additional week. So it's really important to understand the expiration to choose. So Monday, Tuesday, maybe even Wednesday, you would be looking at your entries being an expiration of not the current week you are in, but the following week. Most likely, especially later in the day on Wednesday and then Thursday and Friday for sure, you would actually not want to be in the current week for expiration. You wouldn't even want to take the next week for expiration. You would want to do the week that is following that. So it would actually be like 2 weeks further out from that point instead of just the next week's expiration. So let's go ahead and start going through the use of Fibonacci extensions. What you're going to see here, it's a 1-hour chart. I took it back 90 days. And with that 90 days, I zoomed it in a little bit, and we can find the use of this tool, for our long targets, for calls plays. We're going to want to use a visible low of a move. Okay, I'm just happening to start right here on this candle, which is May 9th at 10:30 a.m. There's a low there, and I'm going to mark to this high and then to this low. Now, where you would use this Fibonacci extension set for is as the chart began to turn around, typically by this candle right here, this 11:30 candle on May 16th, you would be saying, this chart might turn around. Where could it go to? So, just like every other trading system, that you are so rarely going to buy the low and sell the high that you can't depend on it, your goal should be to catch the majority of the trades. Once we have this confirmation that, hey, it's looking like we could go up, we are going to look at entering a strike on the expiration that we choose according to what was previously mentioned, that would go in the money at this 100% Fibonacci line, okay? We want a strike that would go in the money. So this price is 86.07. We would need something that at 86.07 the strike price would be below it, okay? So as we make this trade in this entry, what we're going to watch for, and you're going to see I've got three different lines: the 0%, the 50%, and the 100%. The 0% is going to initially serve as our stop. Now notice please that I marked an absolute low, an absolute high, and an absolute low. So at any time it goes below this point, if you're just doing a single direction trade, that's where you would want to exit. Now many times members will find that that's a good place to enter a strangle trade, and that way, hey, we'll trade the other trade, and sometimes the losing trade comes back and you don't have to worry much about it. So let's go ahead and look at this. You would have entered down in here with the 86.07 as your target. Your 50% line though, let's not get stuck looking at the moon and not noticing we might be standing in quicksand. Your 50% line will always become your first target. If you hit the 50% line and pull back, even though there might not be a lot of profit, that's where you take it. If it breaks back above the 50% line, you'd simply buy back in, and once above the 50% line, the 50% line becomes your stop. So really your first goal in the trade is, can we get above the 50% line? If I get above the 50% line, then if I put a price below it, I can exit the trade and make a profit. Now for me personally, I use a closing price below the 50% line. So yes, that does mean that it could kind of come down a ways and it could stick there, and I could have just sold when it first crossed it. But many times with this trading system, you'll find that it just puts a little candle wick down there and still closes above the line. Now once you're at or above the 50% line, now your 100% line becomes your target. That doesn't mean you have to sell at your target. What that means is that you would sell should it pull back from your target. If it breaks your target, that's great. In this case, you see that, like I said earlier, it's not necessarily about calling the exact price. It's about seeing, when we were down at 84.23, if it was worth the trade to 86.07. Options is a game of $1 moves, so therefore I think the trade would be worth it. And just like these other lines, once you cross this line, it'll serve as support for that trade. So at this point in time, we would have entered out, it would have actually been a couple weeks out, a strike below 86.07, and you can see that we'd have got this run up into the end of that Friday. That Monday popped up. By Tuesday midday, it's still holding this line. We haven't closed below it, so no reason to stop out of the trade, and we would be in the money for that contract. Now, as long as we're in a trade, we need to leave our Fibonacci's on there. But as you can see, you made a move up, you made a move down, and we need to project maybe another potential trade to get in. Now, for the trade we were already in, that 86.07, any 60-minute candle close below there is going to serve as the stop. For the new trade, any price below 85.82 will serve as the stop for it. As you can see, we get up and we get above our 50% line. Again, we actually break our target. That's a good thing. You want to break your target. And then that target will then serve as your stop. Now you will find other times in the trade that you'll need to get out. Simply, it could be the time involved in it. And that's one thing to mention. If you follow the days from this entry here, this day would actually have you exiting the trade for that 86.07 target with a winner. Because this one would have been entered on the Tuesday, you would have had the same expiration that you chose on that prior trade for calls that would go in the money, so a strike price below 88.95. You would have also had to exit out on this day, and you would have been $3 in the money when you did so. Now there's another trade through this that would have been made on this same set, you can see a visible up move and a down move, and then a gap up that next day. Now on that gap up, if you look at it and say, okay, it's at 89.70 or so, and my stop would be 89.13. I've already made money on 2 other trades. I'm going to go ahead and take it. I know where my stop is. Now with this particular trade, you can see that you would have been picking a target, a strike price that would have gone in the money by 93.29. So probably like a 93 call or something. Now in this case, you would have rose up above the 50% line and then pulled back and closed below. This trade would have still been profitable, but not very profitable. But this candle here would have marked your exit at the time where it failed this 50% line. Now, it's really easy to go through this as I showed you where the chart already exists. But now we're going to start going through it in a way where you can't see what already happened before it happens. Now, I want you to notice the time where we failed the 50% line without getting to our 100% line. That's going to be your key indication of a reversal. And in that case, we are going to use a series of high points and low points. And you'll see, first off, you're going to get this wee little one from this top. You wouldn't have even been able to get in this trade. But what this can do here is once it breaks below, it negates this wee little move that I'd marked here, but can serve as your stop should you be buying on this candle. And what would that stop be for? Well, there's going to be a series of moves based on prior Fibonacci sets that we're going to see, and that move may come from this last visible pullback back here, in which case we would take the puts trade on this candle with a stop of any candle close above 91.18 and any absolute price above 92.02. And we would take a strike on puts that would go in the money before 88.58. So like an $89 put would go in the money by that point. Now, as I start fast forwarding through this chart, you're going to find that here we came down really close to the target. We would have liked to exceeded it, but it just so happened not to give that. But as we go back through and look at what it did do, is it gave you the stop out in what would have actually produced a losing trade. Now remember, you would have been in 1 winner, huge winner, 2 huge winner, and number 3, a small winner by this point. So now we're going to see that we did not really get a profitable trade here by the time this closed. I mean, you either lost money or broke even. We're going to call that a loser. But notice something here as it pertains to this 50% line, as it pertains to our other lines, to where not for you to jump into calls right away. Remember, we already broke that 50%, or we failed to hit the 100% line on that calls trade. We got pretty close to it here. We're going to remove these, and we're also going to be looking at the moves that we had. Remember, the one that we failed to hit that 100% line had a marking off of this low, this high, this low. Now, by the time you got stopped out of that puts trade, you were already above this 50% line. That 50% line could then serve to you as a support once you're above it. You're going to have to ask yourself, is it worth trading to a 91.81 target? My answer would be, as long as you're getting in it with the opportunity to still get a $1 move. So you would have to enter below $90.81, and your stop would be this $90.37, any 60-minute candle close below it. Now in this particular case, you'll see that you hit the target, and on that wick pulled back from it. But you didn't get that red candle indication that you were actually pulling back from it, and then you exceed it. Well, the first thing to look at this point isn't just this one Fibonacci set that we have. Remember, if you got in a trade here, now you're up in that trade, you've exceeded your target. But remember I said it was a basis of visible up and down moves. Well, this wasn't much of a down move. If you look at it, it was more of a sideways move. But from here up to here, and down to here was both a visible up and down move. Now you might have caught this a little bit late, but once above your 91.81 and already profitable in one trade, and now on this next candle you seem to close above this 92.03 with the possibility of 95.13, you would find yourself with, should you get continuation on this next candle, that you would want to go into another calls trade, most likely into a $95 strike for calls, while still holding your options trade, your calls trade with that 91.81 target that you're already profitable on. Now, as you can see, you don't really get the continuation until here. So as you enter that trade, and you see that you actually still closing above the line, and still closing above the line, as tedious as it can be sometimes, you're going to see that now you've hit your target, you've looked to pull back from it, but other than it being the opening candle, you haven't confirmed the pullback from it. But at this point in time, you are in two profitable trades. The first thing you should do when it hits this target and say, okay, I know that I could exceed my target, it hasn't confirmed a pullback, but I'm in two profitable trades. Right here's the perfect opportunity to mark from this high to this low and back to this high, to give yourself this puts target around 82.83 or 92.83, 92.03, I'm sorry, to where you could play a puts trade to leverage or get the jump on leveraging your calls, two calls trades. Now on this next candle, you see the pullback. The first thing I would do is exit the calls trade that has the higher stop. Meaning, this one here, that's probably not even in the money now, but still going to be profitable. I would exit this trade as soon as I got that first candle that showed me pullback. And now I've profited on my fourth trade. Remember, I had one break even or loser, 4 winners, another winner that I'm in that's going to be up really nice and $3 in the money, and a puts trade to serve as leverage. As we continue with the next candle, I would exit this calls trade, and now I would have had 5 profitable trades based on this system. Now the first thing to look here is you hit really close to this 50% line and you got a lower wick. If it looks to bounce on the next candle, such as here, you take and move from this low to this high to this low, and now you're getting another 100% target, this 96.87, and you would want to trade a call strike that is below 96.87. More than likely with Apple options it'd be a $96 strike. Now my puts trade is still going to be profitable right here. I've already won 5 trades, and I'm in a strangle with a calls trade and a puts trade. Because we got this pop off the 50% line, you could exit your puts trade. For me, I would rather enter a calls trade and then use that 0 line as my stop for the puts, or as you'll find with me, once I'm in a strangle, I'm willing to risk 100% of one side. And as this kind of makes its way, what you're going to find here, in this case, right here, you drop below your 0 line, which would have caused your second overall loss, but a very small one, as you stopped out of those puts, or those calls, I'm sorry. But you would still be in the puts trade and profitable in that puts trade. Now that you're below that 50% line, your stop is the 50% line. So even if you get stopped out of this trade, it is now going to be profitable for you. Now in this case, you see yourself starting to bounce off that 100% line. And for me, let me go back here because I want to be honest with you. For me, I would have looked at a potential calls trade and maybe even entered one with this positive movement. Now most time, I will wait until I get a move above the prior candle when it's a small candle like this. And that's a discipline you'll have to see. If it's a big candle that dropped like this, obviously you're going to have to kind of guess at it and know where your stop is. But if you got a little candle, you're not missing much to let it get above it. So in this case, you're going to see that, oh, now we've closed below our 100% line in our puts trade. And we can continue in this trade. And could even at this point look at another point. Oh, that was the same point, I'm sorry. Which it's not really giving us, so that we could continue in this trade. So here, we're going to find that come up here, and right here, we would exit out of this trade with profit. This trade would be exited with profit at this point in time. Now, we've got something else to look at here. We've got a low point that we've already used, a high point that we've already used, and a new low in case this bounces. By the time this candle closes, for you to look at your entry, you have to look at where your first target is, the 50% line. If you bought on the open that day, which if you were holding the puts, more than likely you would have already grabbed those calls. But if you didn't, as that candle closes, you're too close to where your first target could be to make the entry. So as we move forward to the next candle, you'll see you begin pulling back from your 50% line. Now, without a doubt, if you had entered that calls trade, this is going to be your exit for it. And we'll watch for continuation as this candle closes and the next one opens. And in some cases, you'll find yourself where, yes, you get stopped out, and then it turns around. And at this point, you'd wait either for a return to your 0 line, a clear breakdown from this to mark a puts trade, or a break over the 50% line to still continue on to your target. Now in this case, we're still not getting the breakdown. We're in a flat line. Now when I talk about a break below a range, you start to see lows being made. You don't have to wait for the candle to close. If you're going to mark for a puts entry, you would want to say, hey, I just broke that low end where it hasn't broken in so long, I need to go ahead and trade that. And as we continue through here, you're going to see we stay in this range, and we actually break below this range here. Now at this point in time, I would take my high right here, my low, and this being the high, and I would enter a puts trade that would go in the money by this 88.53 target. As we get the continuation, I still want to leave that 100% line because the 0 line, that calls fib set, because the 0 line hasn't been failed. If it breaks over my 50% line or taps off of this 0 line without breaking below it, I'm going to enter a calls trade to strangle this puts trade without any hesitation whatsoever. Because we haven't broke that 50% line, and because we haven't seen anything to exit out of our puts, at this point we're still holding just the puts trade. Now you see this is so far 3 days of sideways, and we finally start to break down here. Now on this breakdown, we have to nullify this because we went below that fib set we had for calls. But now we have to watch here because we hit our 50% line and we got this lower wick, and if it were to bounce from here, we would actually be, in this case, taking a loss on the puts. And at this point in time, as you start to see the small candle, okay, you broke above it, I probably would have exited out of the puts right there. Still having this fib set in line because of the consolidation and seeing how it's consolidated, I'm not interested in a new trade until it can break this range of consolidation that I see that it's making. Once I see a break of that range, which could come here, I could again have an active Fibonacci set and ask myself if it's worth trading to that 88.53 target. There's more than $1 move there, so I would say it is. And you see we dip below our 50% line, but we never go back above it so far. And here we do. So there would be the stop out with 4 losses, 6 wins so far. But notice something about the losses. They are pretty small, and half the losses, 2 of those 4 losses, were on leveraged positions for trades that actually made a decent profit. Now, one thing to notice here as well is a general trend starting to form on your chart here. And that trend is a bit of a downwards trend until you see this prior high broken. At which time you've got a couple points to look at. First, let's get rid of this Fibonacci set. Let's look at 2 little potential areas, and they are going to be little here at first. From this break here on this candle, you could enter something that would go in the money on this 93.49. But I want you to look at something else here. I want you to look at how this is really all one visible down move, and that this was all one visible up move. And we have another set to enter a second trade on. And again, we have a nice little set, a stop out for this little trade with the 93.49 target. But then we also have this 95.77 target. As we continue on, we get up through our 50% line. Now we've broken up our 100% line, and we're actually going to be at this point in 2 different trades. Here you see us break below the 100% line. That's fine. We'll take profit number 7 on that little trade. The next thing we want to look at as we start to pull back here is where we might pull back to. The first part is going to be this last high and the lows of this consolidation, and you see it's a wee little target area. The other thing to look at is from the high that preceded our prior low and up into here. Now at this point in time you might say, well, you know what, I might need to enter puts here to this 91.64 target in case I get stopped out of my calls. Now in my case, in the way I trade, once I enter a puts trade, I'm not going to sell those calls because I'm assuming that the down move here, and if I'm trading those puts, I'd watch for this, will make up for the down move I would see in my calls if the stock continued downwards. But the other point I'd want to watch is actually from this high, because this is all one down move, to here, and again up to this high. So being that I was in 2 calls trades and I just took profit on one, I'm going to hold the other and take my little leveraged puts trade. Now if I break down below this 50% line, I'm going to see that there might be some room down to this 88.33 and might enter a second puts trade that would go in the money for that target. So let's watch that 50% line, and as you can see here, the one puts trade I just entered would have been quickly nullified. The other tip I can give you with this is on the puts trades, when you have an active calls trade, if you're visibly this close to your 50% line, your stop point for those calls, see if it's going to fail it before entering the puts trade. But in that case, you would have taken a little loss, but who cares? The calls trade you were already in is going to be up even more. But you did nullify both of those Fibonacci sets, but only made the one entry. And as we continue on here, you're going to see some different highs and lows. Those happen. The important thing to see is where our stop is and where our target is. Now we get pretty close to the target here, but we don't hit it. And here you see we hit it and we again break it. Now the funny thing to also see here, if we were to backtrack this, don't just look at the fact that you're in a trade. As you see, you know what, this come down and made a little move, and here's my prior high, and if I break that resistance, whoa, well, I got a low right here. I made a high and then I made a new low. I might want to take another entry. I might just want to take another entry here for the potential at a higher move to another Fibonacci set. So I'm already profitable in one calls trade. That should make me be willing to take the risk of something that would go in the money by 97.36. So I enter my second calls trade. You see I get up into my 50% line and I start to pull back from it. Now in this particular case, you would identify, hey, I've got an evening star. And where you would be buying was actually at the open of this candle. So you're going to be profitable. You're already profitable in one of the trades. And as this candle closed, showing you that, hey, I'm looking like I'm going to pull back, the next candle that opens, if it continues in the downward movement, you would immediately stop out of the trade based on the pullback from this 50%. So the next candle opens and it immediately doesn't break your low. It allows you to remain in the trade. And now you're over your 50% line. You continue, you've now broken the 100% line of the other trade. And then you come down and reality hits, you sell both trades. You came down and you've closed back below your 100% line. If you waited for the continuation on the next candle, you'd have seen, hey, we opened, we kind of went up a little bit, but we lost that low, and you just made two more profitable trades. That takes your profiting trade total now up to 9, where 2 of your 4 losses were losses on leveraged positions. And now we've got a couple points we've got to watch for pullbacks. First would be this one from our last high, low, high. Second would be this visible down move from clear back here to that low to our current high. Now as we stop out of that calls trade, and what did we say earlier about that? When we hit a point and start dropping hard and we're in calls trades already, we need to take that opportunity to not necessarily sell the calls, but buy the puts until we get the confirmation to sell the calls. So we could have been buying puts, one put set for this 91.37 target. So a puts trade where the strike is higher than 91.37. Now you can see we are now to a point where we would be stopped out of the calls trades, but we would be profitable. Already nearly $2 profit, if not more, in the move down for our puts. And you see how we dipped to our 50% line and gave us a doji candle, and we know a doji candle says watch my next candle. Right here, I personally would have sold those puts. It actually would have been a decent profit, not a lot, maybe 35-40%. And if you didn't want to sell those puts, your other option would be to use a low, use a high, use a low, and take another calls play that would go in the money by 97.63. Now, I, for one, like to do leverage positions and strangles. Those of you that join me in the chat room, you know that, you see that all the time. So in this case, had I not sold my puts, I would have quickly entered calls, and more than likely entered calls down towards this bottom. So at this point, being in calls and puts together, we will begin to allow the trade to take place, knowing where our stop is at the puts, right here. And if it goes higher than there, it doesn't have that much room to the target, but it would still solidify a losing trade for those puts. Now you see we get into the 50% line for those calls, and now we're clearly making a pullback. This next candle did continue down. As it opened up, you continued below the low. You would have sold the calls, but you'd still be holding those puts. Now in this case, let me go back to here. In this case, you might have quickly regretted that decision. But as close as you are to your 50% line, you would then have to let it break above the 50% line before entering another calls trade. Another thing to look at too at this point, if you didn't want to exit that calls trade, you could take from this high to this low to this high and enter another puts trade that would go in the money. The strike would go in the money at 93.07. So it is possible at this point, even if you didn't exit this calls trade on the pullback from your 50% line, you could now be in 2 puts trades, 1 calls trade. The next day, you gap down, and you gap down below this zero line. Now the first rule I have on calls trades, by the way, is I'm never going to sell calls on a gap down, because I do expect gaps to fill. But what you also have is, as you drop down nearly to that 93.07 target, you're going to see the candle come and actually close above both of your 50% lines for your puts. This would have been trades 10 and 11 of profit for the puts. Now in this case, yes, you have a lower low. I just have a habit due to experience, never sell calls on a gap down. See if you can at least fill the gap. Now if it continues falling hard in the first 15 minutes, yet cut your losses and maybe wish you would have sold at the open. But more times than not, you get that little move. But also, let's look at something we have here. We've got another low, a high, and a low. And at this point in time, we're not going to find it profitable to make that trade to that target. So we can remain in our other trade, but we might want to adjust the Fibonacci's we're holding, because we did make a new low, and that adjustment would come by still using that low that we had, the high that we had, and our new low, and then removing that other set. As we continue here into the trade, you see that you begin to pull back below your 50% line. Now if you continue below, you know that you need to exit calls, but you also need to be looking for a potential puts play. And should you be making this, you'd be making it to a 93.12 target. So we're going to assume you bought puts for your calls, and right now your calls are probably, they were break even and now they're down a little bit again. And you hold your low, you didn't break below that low, and you pop up here. Well, this is going to be, with continuation of the next candle for sure, where you exit puts, but we didn't get the continuation. All we did was make a new little high. Well, again, that's all one visible up move. Let's go that last high, the last low, new high. Yes, that 100% line moves up now to 93.46, but we are in a strangle here. We are okay at this point. You see us get down to that 50% line and start to pop up. As we start to pop up here, the first thing you should think is buy another calls trade with this low, this high, this low to that same 97.23 target. So now we could actually be in 2 different calls trades, or sell your puts. I am one here that truly intends to use puts more as leverage positions. When I'm long in something, I'll quickly go to puts for leverage. That's what they're intended to be. So I'm quicker to sell puts typically than I am to sell calls. So keeping that in mind, I would have been one that saw, hey, I've got a similar target. I'll sell my puts on this move up. And that would have been about an even trade on the puts, by the way. Maybe a tiny little profit, but not even something I'm going to count. Not even something I would really look at. So as we continue here, the next day we gap up and we start to run. We come just shy of that target area. We begin to pull back, and the important thing to see here, right here, is that other set that we could have bought calls for, but did give us a new 50% line, gives us reason to exit out of our trade. Now as we exit out of our trade, we take winner number 12 and we look at potential trades to make. Here's a high, a low, a high. Well, hey, we could just bounce again right here. We're not going to be making that trade. But then we're also going to take this last high, this last low, and the high over here. And we might want to take this trade to 93.61. And as we get in that puts trade, let's remove that other 100% line. And we see we dipped below our 50% line, but we closed above it. Here we're holding it. Now the first thing we're going to look at is a calls trade. Well, we're going to use this last low point, this last high point, and now our low. We're going to see a target rate, it's 96.99, right about 97 bucks. And we're going to enter a strangle here based off of this. Now if we break above that, we might have to view this whole move as an up move. But for now, we got to use just our last low, our last high, and the current low. So we enter our little strangle trade. Now it's going sideways. And the next day we gap up. Remember what we did when it gapped down? When it gapped up, look where it gapped up to. It hit that 100% line. It went just a couple pennies above it. Immediately on the gap up, we're looking at not exiting the puts that are going to be down tremendously. We're looking at exiting the calls that will be up due to the implied volatility. Winner number 13. Now at this point in time, we also have that mindset that there's a good chance that this goes to at least fill the gap. Right at that open, when we're sitting around very close to $97, we are going to see this gap fill area, which is right at our other 50% line, happens to be a new 100% line, and a $1.50 move, $1.70 move actually, which is one we would trade for. So as we make these trades, we also have to understand that we needed to adjust this Fibonacci set. We're not selling puts on a gap up, but that was based off of this high, this low, and this high, but we just happened to get a new high. So now we'd have a 93.83 target, which is slightly above what our prior target was, but still one that we're going to have to recognize and potentially trade for. So here we kind of, we're right at the 50% line. Well, now we've broken below it. So this second calls trade or puts trade that we took, we're already profitable in it. We're still about probably break even on the one that we held through the gap up. But we've crossed this 50% line on this puts play, which gave us a better stop. Now you see we dropped below the 100% line for the new puts entry, and we're headed towards the target for the old puts entry. As we get down here, we get to that 100% line, we break below it. At this point in time, we're staying with our puts. Not only are we staying with our puts, but we may have to look for what other target we could trade to. This other target could be found in this particular case, nowhere. We had our up move, we had our down move, we had little sub moves within overall directional moves. So we simply have to remain here and use this 100% line that we have to stop us out of both of those put trades, both of which would be profitable. And you see right here, we actually come and close just above that line. As the next candle opens, if it doesn't immediately go red, we stop out. While it opened, it might have pulled back, but you broke back above, the candle went green, you'd stop out, and you just had profiting trades number 13 and 14. At this point in time, we have two things we got to look for. We've got to look for the shorter move. We had the down move here into an up move, and here, and you've got to say when you're in those two puts trades, maybe you'd entered down here, but there's also not a lot of room, and if you waited for the break of the 50% line, you didn't get to make this trade. But you also have this one to give you a calls trade to that 96.15 target. And as we continue, you see you get to that first 100% line. So cool, that little set, we don't have to worry much about it. It actually hit it and pulled back though. So even though we were trading to this target, we're gonna want to observe this, and if we continue on that next candle to still pull back, we're gonna have to exit this calls trade with what would be a very small profit. And we did continue to pull back, and because we did continue to pull back, we have to take that very small profit. Now we're going to go ahead and remove this, but I'm going to keep this here to show you that you didn't drop below your 50% line for the close, which in fact could have kept you in the trade. So make sure, and I purposely did that for the video, that you're not confusing yourself. Know where your lines are and which ones you're trading. And sometimes you could sell too soon. Now here we do happen to close back below that 50% line. We gapped up and we started to fall. The first thing we should look at on a gap up is a puts entry. Not, well, it'd also be a calls exit, but that really wasn't a big gap up. So we would have stayed in those calls and we would have taken our puts entry. Now remember, once we're in that puts entry, we're not so much looking at what could happen in relation to the losing side, or we're not necessarily being quick to stop out of that calls trade. As we get here, our puts are continuing. We're just leveraging with the puts. Ooh, we start to pop back up and back down again. And now here on this gap up, you start to pull back. It wasn't a big gap. It wouldn't have you selling calls. It wouldn't have you selling puts either on the gap up until it started rising back above giving you reason to exit those puts. So yep, you just took 5 losses so far with this trade system, but 3 of those losses were leveraged positions. You're in a big winner right now. And another thing to look at is we have one big up move here to this high, all this down move, and we might need to be trading to this $100 target now. So when we gapped up, started falling, but crossed back above the opening price, yes, we're going to exit that one puts trade for a loss. We're going to be already winning in a calls trade, and we're going to look at one of two things. A, you only got 50 cents until your 50% line. It's not $1. But when it crosses that 50% line, we've got almost $4 to trade for. So either way, by the close of this candle, you're in another calls trade. Your new 50% line's your stop. And remember, your 100% line for your other trade was right here. You've now broken your target, but have not given yourself reason to believe you need to sell it, simply because you haven't pulled back from it yet. As you continue, you're above your 50% line for the one trade, you're still above the 100, you come back and you touched your 50% line. Still in both of these trades, actually. You're going to start to see some things. You could have actually maybe made another trade entry there. I didn't see it quick enough, so I don't want to try to say that I would have. But yeah, to that 101.73, you could have made that. In which case you might have sold that one here as it pulled back. I probably would say that you had to. And the other thing to see here is the importance of one particular thing. This 50% line, you hit it pulled back. So, had you made that, there would be winner 15. You're already in two other winners. But once you hit that 50% line and pull back, without breaking above it to your 100%, you've got to begin to look at a puts trade. So, if you got in this one, you'd have sold it. There was a winner. You're already holding two winning calls trades. You're wanting to sell or to buy puts to leverage them. So you'd have bought puts somewhere in this area for this 94.91 target. Again, continuing, and you actually see you've tapped both your 50% and your 100%. That 50% line is going to be a break even or loss on that other trade. But you're also taking a winner here, winner number 16, and your puts are winning too. You see, you get pretty close down to that 100% line. Here, you hit it, close above it. So any positive movement that would continue, which would be, I'd say, a break above this candle's high, you'd be exiting that puts trade. And here, right there, exiting the puts trade. Now, at that point, though, one thing to understand is upon that exit, you would have also been looking at the potential for a calls trade. You've got this up move and this down move. So before you exited on those puts, you are going to be looking for this calls trade to this 101.68 target. Here you exit on your puts, you took winner number 16. We'll go ahead and remove these. You're still holding your calls. And then all of a sudden you start to say, hey, this might be a lower high. And you get that indication right here. So the first thing you're going to want to do before you even exit out of those calls is you're going to mark your high, your low, and then a new high. And when you see yourself get this failure, I would leverage with the puts immediately. Leverage it with the puts so you don't have to worry about it. And then play the continuation of the next candle, which actually went up. So you'd have held both, you'd have held both, you'd have held both. Here you'd still be in that strangle. And here you break below this prior low. You sell that calls trade for a loss. But you're up on your puts. And as you continue, we're going to see where we are going to be in a position to sell those puts because we didn't hit our 100% line, but now we've closed back above our 50% line. And if this candle's open, we're going to sell those puts, probably at a break even. Probably even at that point, maybe wish you still held those calls, but that's just part of trading. And we have a visible up move, a visible down move, and we didn't get to our target area, which makes us think we could change direction. And we're going to enter a calls trade for this $100.15 target. So as we continue, we get to our 50% line, we start to pull back. We're looking for continuation on this candle that breaks below this low. We don't have it yet. And here we do. Here we do. Now again, you're going to be thinking, I hit my 50% line and pulled back. Crap. I'm going to use my last high, my last low, and this high. I've got a dollar move. I'm going to leverage this with puts right away that would go in the money by this 94.21. So I'm not going to worry so much about my calls, but I am going to take some puts. Now at this point, right here, bye-bye puts. Bye-bye puts. It's basically a break-even trade, but my calls went up. I'm okay to let those puts go. And my 50% line, or a close below it, is going to indicate my stop. Now something else to look for at this time too is you did have an up move and a down move. You could have made another trade on 99.21 calls. So you could be in two calls trades here. Both of them would be up. Here you hit your first target. You start to look like you might pull back, but you don't get the continuation. You break that other target. Wow. But did you notice something else? I hope you did, because if you were following along at home, you would have actually been in a third calls trade. And at this point, all three of them are up. Which we gotta like it when that happens. And here, we'd have exited this calls trade. Gone. That's winning trade number 17. And then you see, well, shoot, it turned right back around. Well, we're still in two of them. But is it possible we found another entry? A low, a high, another low to trade and get us back into a third trade with 103.86 as our target. So 3 calls trades at this point that you could be in. You held your zero line, still holding all 3. We got to the 50% line, but we didn't pull back. Well, we are kind of pulling back. So at that point in time, you'd have used high, low, high, and there's not a dollar move there. So you're not playing the puts, but you want to leave that target there so you can see where it bounced. You came down, you filled this gap, and you look at it, wow, that's kind of holding up pretty well at that bounce point. And there she goes again, so we'll get rid of this one. But we actually have another low, a high, and a low, at which point you could be in a fourth calls trade off this bounce that still had $1.50 to go, $1.60. Here you hit your 100% line, you make that first candle pullback, and the next day you gap down. We're not selling calls on that gap down. But we did go back up to our 100% line. Right here, we hit that 100% line. And on that 100% line, we started to pull back. So our next candle, didn't pull back. Now we've broke it. Started to pull back. Haven't broke that low yet though. Another gap up that did come and close below this candle. Continuation on the next candle. Didn't get it. And here we are, coming really close to this target and pulling back from the low, or from the high. We're only 10 cents off from that target. That's pretty darn close. And we did pull back below the low of this candle. So we'd take profiting trade number 18. Here we'd have taken profiting trade number 19. And ironically, I missed this. We'd have been out of both of these due to expiration. So it would have been 20 and 21. Now, on this here, I'll tell you, you wouldn't have had any reason to expect to play the puts. Right here, you would not have had a reason to expect to play the puts. But in seeing where it could go, we might actually have to come out of this a little bit, because we were right at this time. And we've got to look at the moves, okay? We had a high here. That was all one down move, all one up move. And then we broke below that 102.27. But here we have a high with one visible down move and one visible up move. I had to zoom it out so that we could see it to get in there. Let me zoom back in on the chart. And with those points marked, let's look at how this could have been traded for anybody that was watching it. Let's get back up to the point where we were. Here we go, and that next day you start falling. Well, this wouldn't be weird for me to say this because I've said it on 2 other trades. When it breaks below this 102.27, you use the 102.27 as your stop to enter a target for this 97.45. Now here you can see you closed just at that 50% line. You've started to move below it. Now you're starting to look like you might come above it. Well, you didn't stop out yet. You got real close to your 100% line. You made a pretty good move up above it. Nothing yet though. Nothing yet to make you sell that trade. And at this point, you actually may still be in that puts trade, which would be winning trade number 22 over the last 90 days, all of which were actually good size winners, and 5 losers. 5 losing trades over the past 90-day period. Now, the reason it's important to study this and actively be persistent with this chart is because you won't have that same reaction unless you can remain calm with it and make the trades based on this lesson. And if you make those trades, you should be able to replicate the success of this trading system. Remember, we are not concentrating on one green candle, one red candle. We're concentrating on visible up and down moves. Visible up and down moves. And as you saw in this example, over the past 90 days, using this system, we could have had 22 winners, 5 losses. And I'll take that any day.